So this week we will be covering Chapter 8, which is on profit maximization, and this chapter will also be wrapping up Unit 2 for us. Alright, so we've learned how a firm maximizes revenue, and then of course we have learned how a firm can minimize their costs. Now profit is going to be what the firm is ultimately trying to maximize, and profit is simply going to be whatever is left over after a firm has paid out all of its costs in relation to its revenue. So again, the easiest way to see what profit would be which would just be the formula total revenue minus total cost. Now we know that the three costs that the firm is paying for are their resources. In other words, firms have to pay for their land, labor, and capital. After they've paid out whatever is left over, that is going to be their profit. Now what we want to do is look at the cost to the firm in terms of their opportunity cost. In other words, the amount necessary to keep the owner of the resource from using it in an alternative use. And the reason why we look at it from this perspective is because we know that resources have to be paid their opportunity cost, otherwise they will flow to an alternative use. So again, let's say that you happen to be the resource owner of land. Let's say in Bakersfield you own acreage of land that you rent out to a local farmer. Let's say that local farmer pays you $500 a month to lease each acre of land. But let's say an alternative farmer comes along and says he's willing to pay you $700 per acre of land to grow his crop. It doesn't take a rocket scientist to figure out that you would then allow your land resources to flow to where it is more highly valued. In other words, you would start renting your land to the farmer that's willing to pay you $700 opposed to $500. Once somebody's offered you $700, that means that is the new opportunity cost for that good. In other words, that's the highest valued alternative use that resource will be utilized in. So in order for the other farmer to continue to use it, he would have to pay $700 because that's the opportunity cost. Let's say we're talking about the resource of labor. So each one of us as individuals in the labor market own our own resource of labor. Therefore, we get to dictate which firm is going to be allowed to utilize it. So let's say, for example, you get two job offers. One job offer pays you $15 an hour. Another job offer pays you $20 an hour. Again, that would mean that the opportunity cost of your labor is whatever the highest valued alternative use of that resource is. So again, you would allow your resource of labor to flow to the employer that's going to pay you $20 an hour opposed to the $15 simply because that is your opportunity cost. Now, when we talk about the resource of capital, we divide it into two different categories. We have what's called debt capital and we have what's called equity capital. So an owner of debt capital is simply going to be, a bank, somebody that gives a loan to a firm so that they can continue to produce their goods and services. And so the business is now going to have to pay interest on that loan that they received. So again, that is an example of debt capital, the interest that is paid on the debt. Whereas equity capital is something different. Think of equity capital as the sale of the ownership rights of the firm, or in other words, stock. So if you own stock in a company, then you are, an owner of equity capital. And the cost of equity capital is going to just be the alternative return that an investor may have received had they invested elsewhere. And so equity capital is going to vary from person to person because our opportunity costs are going to be different. So in other words, let's say that I had bought stock in Disney, and I was currently getting like a 3% return, and then I turn around and I look and see that the Apple stock is getting like a 5% return. Again, that would induce me to want to invest in the Apple stock opposed to the Disney stock because I'd be able to get a higher rate of return. In other words, that would become my new opportunity cost. I would need to get at least a 5% return in order to keep my money in a particular stock. And I'll go into this in a little bit more detail a little later in the lecture slides. But the reason why this is important to distinguish between debt and equity capital is because it allows us to calculate two different types of profit. Economists distinguish between what we call accounting profit and economic profit. Now, the type of profit that you are most familiar with is accounting profit. That is the type of profit that you see corporations listing in the Wall Street Journal quarterly. That's just going to include all of the actual tangible cost to a firm. So we take in the total amount of revenue that a firm generates, which we know total revenue is price times quantity. So whatever the price is of the goods that they're selling multiplied by the quantity of output they're producing, that gives you your total revenue. And then you subtract out the total cost of the firm. So you subtract out any land costs that they have, any labor costs that they have, and then of course any interest that they're paying back on their debt. So that debt capital. And whatever's left over, that is what we call accounting profit. Economic profit is something different. Economic profit is going to be where you take the value of that accounting profit and then you subtract out the cost of the equity capital. And economic profit is the profit that firms are more concerned with because that is what's going to indicate whether or not a firm is going to be successful in the long run. In other words, you cannot consistently have negative economic profit and expect your firm to exist in the long run. Another way to think of the difference between accounting profit versus economic profit is to think of the costs that a firm incurs in terms of explicit costs versus implicit costs. So explicit costs, we all know what explicit is. In other words, that is an actual tangible cost to the firm. In other words, you can measure it. Think of it as a bill that a firm gets and they have to pay for it. So in other words, if they have to pay for their land, if they have to pay for their materials, those are tangible costs. You know, they have to pay their payroll. In other words, their employee wages. Those are all tangible costs that the firm has to pay. So whatever's left over, of course, that's going to be the actual accounting profit. So any costs that actually involve tangible spending are going to be included in the explicit costs, whereas economic profit measures something that we call implicit costs. In other words, these are just the implied costs of doing business. And this is where we are saying that resources have to be paid their opportunity cost in order to keep them utilized in their current use. So again, these aren't actually explicit costs that the firm has to pay every month, but it's implied that the firm is going to meet these costs. So in other words, any resources that are being utilized in the production process, it is implied that they are going to be paid their opportunity cost, their highest value in the market. So let's look at a couple examples. I think when we look at the examples, it makes it more clear the difference between an explicit cost and an implicit cost. Let's look at an example for like an individual. Let's say, for example, I currently make $100,000 and I decide to leave my job to start my own business. So again, if we're looking at what the value of my labor is, because remember, labor is a resource in the market. If I'm leaving a job making $100,000, then what that means is that is the value of my labor. Again, that's the same thing as the opportunity cost. In other words, the highest valued alternative of my resource. So let's say to start my own business, I take out a small business loan of $50,000, and let's say the interest rate on that loan is 10%. So that becomes a capital cost to me in terms of the debt capital, right? In other words, I have to pay the interest on my debt. I use my own money to invest in the business also. So let's say I invest $50,000 from my savings account into the business. And let's say that for the first year, my yearly revenue was $120,000. And my operating expenses, in other words, the land and the labor costs, were only $25,000. So this makes it very easy for me to calculate out what my accounting profit is, because I just take the amount of revenue that my firm generated and I subtract out all of those tangible costs that I have to pay. So again, I made $120,000 revenue. I had to pay $25,000 for my land, materials, and labor, and then I had to pay 10% interest on my debt payments every month, and that came to $5,000. So at the end of the year, I was left with a $90,000 accounting profit. So it looks pretty good, but what I really want to look at is the value of my economic profit. I want to look at the opportunity cost of anything that was used in the business that was not accounted for in the accounting profit. So again, let's look at that $50,000 that I took out of my own bank account to put into the business. If I had not taken that money out of my savings account and put it into the business, then hypothetically that would be sitting in the bank earning interest. So suppose that I could have put that $50,000 into a certificate of deposit account where it was actually going to earn a 10% return. Then that means the opportunity cost of that $50,000 comes to $5,000. In other words, that $50,000 would have made $5,000 had it been sitting in my certificate of deposit account. So we have to take that into account. The money that I would have made off of that money had I left it in that investment account. And then I also have to take into account the value of my labor. In other words, remember, looking back at this previous slide, we said that in my previous job, I was making $100,000 a year right here, which means that is the opportunity cost of my labor. Therefore, I have to take that into account also. So again, now I take the value of that the accounting profit, $90,000, subtract out the $5,000 I would have made had I left my money in the bank, and then subtract out the value of my labor, in other words, the amount of money I would have made had I continued at my previous job, and we see that my economic profit is actually negative $15,000. What that means is I'm worse off than what I would have been had I just allowed my resources to stay where they were. In other words, remember before, I made $100,000 at my job, plus I had $50,000 in the bank that would have made me $5,000 that year. So in other words, you add 100,000 plus 5,000, I would have made $105,000 that year based on allowing my resources to stay where they were being utilized. Whereas now, in this job, utilizing those resources, I only made $90,000. So even though my accounting profit is positive, it's $15,000 less than what it would have been had I just allowed my resources to stay where they were more highly valued. So that is why the economic profit is negative, because I didn't allow my resources to get paid their opportunity cost, their highest valued alternatives in the market. So you can see how economic profit is what we are more concerned with for the firm. In other words, if I consistently have negative economic profit, meaning I'd be better off allowing my resources to be utilized elsewhere, eventually that's what I'm going to do. Now, when we're talking about an individual's choice in the labor market, we can kind of play with these numbers because oftentimes in the labor market, we do see people that actually take on jobs where they make less money than what they're capable of doing somewhere else simply because they are placing a positive value on the amount of utility or happiness they derive from their job. So let's say, for example, that in my previous job where I was making $100,000, I wasn't very happy. And so I was basically willing to take a pay cut in order to do a job that I actually enjoy. So to understand how much of a pay cut I would be willing to take, I need to place a value on my happiness. In other words, how much do I value my happiness? So let's say that I place a value on my happiness in the labor market of $25,000, which is what we see right here. What that basically means is I'm saying I'd be willing to make $25,000 less as long as I'm doing a job that I like, because that is what I am valuing my happiness at. So now when we place a positive value on our happiness, so we have the negative 15,000 economic profit, but we add back in the 25,000 that I placed on my happiness. Sorry, my pen's not working too good. That means that my economic profit is now a positive 10,000 again. So in this case, now we would say, well, it's a perfectly rational decision to make because I placed a $25,000 value on my happiness, and so my economic profit is still positive. Now, of course, you can't do this for like a corporation, but you can do this on an individual basis when we're talking about accounting profit versus economic profit. All right, so let's do one more example so that we, again, understand how to calculate the difference between accounting profit and economic profit for an individual. So suppose Lisa leaves her job as a teacher where she earned $40,000 a year because she wanted to start her own tutoring business. She used $25,000 of her own money, and she also took out a small business loan of $50,000 with a 5% interest rate that she's going to repay. For her first year, her business is bringing in $60,000. Her rent and labor expenses equal $15,000 for that year. And had she not used her own $25,000 to start the business, she would have put it in a CD earning 5% interest. So again, the first thing we do is calculate the accounting profit, where you just take the total revenue and subtract out all of the explicit costs. So it said that her total revenue was $60,000. So subtract out any land and labor costs that she has. So it says that her land and labor costs were $15,000. So we subtract out the $15,000. And then subtract out any debt capital that she has. So it says that she took out a $50,000 small business loan with a 5% interest rate. So she's going to end up paying back $2,500 in interest. So $60,000 minus $15,000 minus $2,500, she is left with a positive accounting profit of $42,500. So that is the value of her accounting profit. Now we want to see what is her economic profit, and that is where we take out any of the implicit costs. In other words, the opportunity costs not accounted for in the accounting profit. So we take the value of the accounting profit, which was $42,500, and then we subtract out anything, again, any opportunity cost not accounted for. So it does say she was making $40,000 a year, so that was the value of her labor, so we have to subtract out that. And then it also says that when she used her own money, that she could have put that money into a CD earning 5% interest. So she had $25,000 of her own money. So had she put that in a CD account, she would have made $1,250. In other words, $25,000 times 5%. So $42,500 minus the $40,000 minus the $1,250, we're left with a positive $1,250. 1,250. So again, that is the value of her economic profit. So we can see that she's $1,250 better off than what she would have been had she left her resources where they were before. In other words, if she continued to work at her old job, she would have made $40,000, and if she had left her $25,000 in the bank, she would have made $1,250. So she would have made $41,250 for the year, whereas when she allowed her resources to flow to the more high value, she has a positive $1,250 in economic profit. All right, and to wrap up the first part of this lecture, let's just do one more practice round. So again, suppose Dan quits his job as a banker, making $80,000 a year to start his own financial advising firm. His annual revenues for the first year are $175,000. And then it says that his rent and materials are $45,000, so we subtract out that explicit cost that he has to pay, and he obtained a business loan of $100,000 with a 7% interest rate. So that means he would have ended up paying $7,000 in interest. So $175,000 minus $45,000 minus $7,000 would be $123,000. So that would be the value of his accounting profit. But now again, we want to look at what is the economic profit. So we take that $123,000 and we subtract out any resource or opportunity costs that are not accounted for in the accounting profit. So it says he was making $80,000 a year, so we have to subtract out the $80,000. Plus, it says he used $50,000 of his own money, which would have earned him an 8% return had he invested it in the stock market. So 8% of $50,000 is going to be $4,000. So if we do 123,000 minus 80,000 minus 4,000, we come up with a positive 39,000. So the value of his economic profit is 39,000. So again, that's the same thing as saying he's $39,000 better off than what he would have been had he kept his resources in their previous use. You know what, now I'm looking at this problem and I realize I left out the labor expenses. In other words, I skipped right over that and went straight to the rent and material. So all of this data is actually incorrect. Okay, so now let's go ahead and do this over. We take the 175, we subtract out the 50,000 for the labor expenses, we subtract out the 45,000 for the rent and materials, and then we also subtract out the 7,000 he's going to end up paying on the interest on his debt. So 175 minus 50 minus 45 would be $73,000. So his accounting profit would ultimately have been $73,000. All right. Now to calculate the economic profit, we take that $73,000. Looks like I'm going to need a new pen here soon. It's not working too well these days. $73,000, and now subtract out any opportunity costs that are not being accounted for. So it says he would have made $80,000 had he just stayed at his previous job, and it says that he would have earned an 8% return on his $50,000, and so 8% of $50,000 is $4,000. So 73,000 minus the 84,000, let's see, is actually a negative 11,000. So in this case, his economic profit is actually negative. In other words, he would have had more money had he just kept his resources where they were before. Because again, prior to starting his own business, he was making $80,000 from his job, and then of course he would have made an 8% return. So he would have made a total of $84,000. But notice that with his business, his accounting profit was only $73,000. So he's $11,000 worse off by starting his own business and allowing his resources to flow to a lower value. So the only way that we could justify somebody doing this would be obviously if he was placing a positive value that was greater than $11,000 on his happiness. Another thing, of course, we like to take into account is this is just for a 1-year example. Oftentimes firms will make less, and if he expects that his revenues are going to increase in the long run, then eventually his economic profit would be positive.